Let's say the Saudis really break the petrodollar system. I can guarantee you, almost guarantee you, within the next week or the next month, the United States will send in a flotilla and armada of ships to Saudi Arabia to get them to reinstate the entire petrodollar trade. The whole idea of this is because the US has to consistently print money. And that's why we have to understand that de-dollarization is going to be death by a thousand cuts. It's not going to be some miracle one day event, a Hail Mary, Hallelujah event where suddenly the whole world decides to immediately stop trading in dollars, buying and selling oil in dollars. It's going to be incremental at the fringes before it accelerates momentum.
Hey everybody, Smart Silver Stacker here. Hope you're doing well. I'm joined today by one of my favorite YouTubers, Sean Foo. And Sean, really excited to pick your brain today about some of the ongoing trends that we're witnessing in geopolitics and the global economy. Welcome back to the channel. How have you been?
Yeah, not bad, man. How have you been?
I've been really good. But watching these things play out before our eyes, the massive expansion of debts and deficits around the world, the devolving geopolitical situation. I'm just really excited to hear your take on some of these things. And to kick it off, why don't you just go ahead and give us sort of your overview of the situation at the moment, and what are some of the trends that you think we should be paying attention to right now?
Well, I think we've come to a point that we can't really avoid geopolitics when it comes to the markets, economics, and investing, right? It's quite interesting that most of the time when I speak to people out there, they kind of say that just focus on the market fundamentals, interest rate policy, but we have to look at geopolitics as well, especially when it comes to inflation and gold. And I think the best way to start it off is the recent confiscation of the Russian assets by the G7, right? And I think that really sparked off a very big catalyst that's going to propel gold higher. It's going to send inflation much higher as well. And going forward, I think it's going to look really ugly for the US bond market going forward as well.
You're referring to the recent plan by the G7 to give loans to Ukraine from the revenue generated by seized Russian assets. And you say that that will be a catalyst for higher inflation and problems in the US debt market and higher gold prices. Unpack that for us. How will that affect these factors that you've mentioned?
All right, sure. So let's talk about inflation first, right? So we do know that the G7 has around 200 to 300 billion dollars worth of Russian assets stuck there. One thing that we must realize that this is money that was sitting in the Euroclear system, which is basically a clearinghouse. It's money that's not circulating around the economy. So what the G7 they're trying to do, US, their allies, and Europe, they're going to pump $50 billion into the system, collateralized by the Russian reserves. So the big problem now is this $15 billion is going to circulate around the economy, and obviously it's going to go towards the MIC, the military industrial complex. And what are they going to do? They're going to take this money, they go out to the markets, and they're going to buy oil, they're going to buy metals, they're going to buy commodities, copper, what say you, in order to build the war machine. And obviously, when you have this big influx of money that they can ramp up all the way to 300 billion entering the economy, we are going to see inflation go up or at least stay high for the time going forward. And when it comes to gold, we must look at what countries in the global south, especially China, is going to see from this. There was a time when countries did this thing called sovereign immunity, right? When you put money into a financial system, unless you do something very egregious, and even if you do it, your money is supposed to be sacrosanct. No country is supposed to go in and take your funds. And now that China, one of America's biggest debt rollers, bond buyers, they've seen this, what are they going to do? They are basically going to de-dollarize their entire economy to the fullest extent that they can. And the biggest actually hill they have right now is their treasury holdings, which are, if I'm not wrong, is somewhere between 600 to 750 billion dollars right now, inclusive of what they hold in Hong Kong and Belgium. That's probably still near 900 to $1 trillion. So what are they going to do? They're going to take the money, they're going to divest it away. Maybe they're not going to sell everything at once because they'll send a really horrible political statement to Washington. They're just going to let the bonds mature over time. And where do you think they're going to take the money and pile it into? One big avenue is going to be gold.
That makes sense. And we have witnessed for over a year the Chinese central bank expanding their official holdings. But, on that note, we did get a brief pause. I'm going to call it a pause, not an end, although, certain elements in the media seem to think China is done buying gold. But they did pause in May. And that had a significant downward effect on the gold spot price. Now, my thought on this is that, China will probably begin buying the dip that they have actually caused by this announcement. Yeah, to your point, China has been dumping US treasuries for a long time. In Q1 of 2024, they dumped a record amount of US treasuries. And it makes sense that they wouldn't do this all at once, right? If they're trying to unload their treasury holdings, they don't want to crash the price of those instruments by selling a huge amount of them onto the market all at once. But as you say, gold will certainly be something that they're looking for in this environment, because gold, unlike the dollar and unlike treasuries, really is sacrosanct. Once you have it, you don't have that counterparty risk. Do you think that other nations around the world are going to get that same message from this confiscation that we're witnessing of Russian assets by the G7?
Yeah, exactly. I think they're going to follow what China is trying to do, right? And let's really try to unpack what China's playbook is going to be. So the underlying idea of investing into US treasuries, US bonds is basically take your money and put it into an asset that yields 3, 4, or even 5% yield today, right? And the underlying idea is I put my money to bonds. Over time, I hope to be able to earn more proceeds from the money in order to buy more commodities, more energy. And that's the only reason why countries actually put their money into bonds, whether it's US bonds or Euro bonds. However, now China is faced with a dual problem. The first problem that we encountered is, of course, the confiscation of the Russian assets, right? Even though the Fed has been hiking rates all the way up, and we know when rates go up, bond values drop, right? It's inverse relations. And China probably suffered anywhere between 10, 20, or even 30% down on their bonds. But now that confiscation is on the table, we are past the point of no return. There's simply no limits now. Nothing's off limits. Well, the biggest downside China can get in their bond holdings is minus 100%, right? They'll be left with zero if a total confiscation happens. So there are only two avenues for them to play right now. I think every other countries are doing that. So the first is obviously gold, right? And as you said, gold is Seko's kingdom, is held within your own vault. And this is exactly why we kind of saw India repatriate their gold back from the UK. They kind of gave quite a funny reason that they have empty vaults in the country and they want to bring the gold back to store it there. But that's kind of a bit of a moot point. I think they saw what happened to Russia. They know that they're still actively trading with Russia. And if things really get hairy, there's always the chance, there's always the possibility of the gold getting taken away. And for China, they kind of have only two avenues. One of it is they can take the money and go around the rest of the world. They can start to buy up commodities and commodity producing assets, right? And that's why you see China going around Peru, going around Australia, trying to buy lithium mines, silver mines, gold mines, copper mines, anything under the sun, a rare earth mines, you name it, they're doing it. They're trying to, instead of taking the dollars and putting it into treasury bonds, they're going out there right now and buying up the commodity producers themselves. But at the same time, you kind of see the pushback China is getting around the world, right? The overcapacity claims. The same thing is actually happening when it comes to their acquisitions of hard commodities around the world. Just recently, Australia made a Chinese company sell off their stake in a lithium mine, if I'm not wrong. And we're going to see that play out in many other countries as well. So China can't go around and buy up all the resources in the world. They need to channel it to another place, another store of value. And the only other store of value I see possible long term that they can really stacked to their advantage is gold. And other countries, they said, I think they're going to follow suit as well to varying degrees, of course.
A few things come to mind here. One is that China really does have something to be concerned about here. I saw recently Jens Stoltenberg, the NATO Secretary General, was threatening, basically, I mean, that's what it sounded like, threatening China with sanctions for their continued support of Russia. So this is also not something that they're just inferring from Russian asset confiscation, but this is something that is a real threat that the Chinese may face, and Western leaders are telling them as much. And also, I think one thing that you'll hear when you talk about China putting their trillions of dollars of treasuries and US dollar reserves into an asset like gold is that there's not enough gold. But there's always enough gold, is my take on that. It just depends on what the price is, right? So to me, as China continues to move these dollar denominated assets into hard tangible assets without the counterparty risk, we will see the price of those assets appreciate significantly. And I think part of the reason that China paused in May was simply because the gold market was hitting record all-time highs, perhaps had gotten a little overheated. So again, it doesn't benefit the Chinese to drive the price up of an asset that they want to acquire more of. But what do you see the price of gold and also silver? I mean, we talk about silver a lot on this channel. Where do you see those headed as a result of these trends?
All right, so this is this is a difficult question because trying to make a price prediction is always a fool's game, right? But let's use some statistics on this. So I think it's fair to say we can measure the returns of gold from 1971 when the gold standard broke. So this is something that I did on my own. It's quite fascinating when you look at the annual returns of gold. So from 1971 all the way to today, I think was around $35, all the way to $2,400. The average return of gold during the entire period was around 8.5% a year, right? So, I mean, if someone can't beat 8.5% a year returns, they might as well just put their money in gold. But here's the fascinating thing. Since 1999 or 2000, after the dot-com bubble crashed and the first instances of QE started to come, gold actually returned around 9.5% to 10% a year. So the returns are actually going up. So from the year 2000 all the way to 2024, where we are today, you actually yield 10% a year on gold. So knowing this and knowing the situation that we have today, where countries are all afraid of holding too much treasuries, right? Whether you're so-called an adversary of the US like Iran, Russia, China, definitely you're going to buy more gold. But we're starting to see a trend where other countries that are working closely with the US, like Poland, if my country is Singapore, we are buying more gold at the same time. So you're looking at a very small market and a lot of money that's going to consistently get churned into the metal. So going forward, I think getting a 9, 10, or even 11% return a year over a very long period, 10, 20, 30 years, I think that might be actually baked into the cake going forward. So if gold prices ends the year, at 2,500, 2,600, I won't really be surprised. I mean, we had a very big run up now. So having a correction is actually quite healthy. And to your point about China not buying gold, it absolutely makes sense. Would you want to buy an asset for a cheaper price and not telegraph your moves? Or do you want to tell the whole world? And you have been telling the whole world for the last 18 months, right? You might as well just take a break, let prices crash a little, and then pile in more into the asset, right? Now, for silver's a bit of a mixed bag, I would like to say. Now, always advocate having some physical silver with you. And everyone has to determine the amount that they want, whether it's 100 ounces, 500 or 1,000 ounces. But silver is going to be very volatile, and we are going to see a lot of instances where the prices spike all the way up, prices crash all the way down. And if you're stacking silver for the long term, that shouldn't really concern you. But at least for myself, I do hold some paper silver, and if prices suddenly spike to the moon, I do sell it off, but my physical holdings never change. So it really depends on how you're seeing things and what are your strategies going forward?
That is typically the approach that I take as well. Dollar cost averaging. I've never sold a single ounce of physical metal myself, but paper positions, that's kind of what they're for, or suitable for trading. We were talking about China dumping U.S. debt. Now, I want to look at that from another angle, and that is the amount of debt which we are issuing here in the U.S. So around the world, we've got players such as China lowering their treasury holdings, and yet here in the U.S., we're borrowing record amounts of money, running huge deficits. Just last month, according to the latest monthly Treasury report, the deficit eclipsed $347 billion in May, which is, I mean, obviously, if you annualize that, that's over $4 trillion. I think May was a little bit of an outlier, but we're borrowing huge sums of money. So what do you think the combined effect of international debt holders dumping U.S. treasuries along with the ramp up in deficit spending in the U.S., what effect do you think that will have on markets?
It sets up a real disaster for the markets going forward, right? Right. So just recently, I think on Zero Hedge, they came up with an article about a Japanese bank that's on the verge of collapse, and they're selling off another $65 billion worth of US treasuries and other bonds in order to plug up their hole. And I think this kind of banking crisis, this kind of debt crisis is going to escalate and it's going to spread across the entire system. Now, to your point that America is constantly spending money, issuing bonds, raising debt in order to fund all sorts of questionable adventures, right? To put it mildly. The problem with this is that the consistent buyers of these bonds are starting to retreat. There's a chart going that I've shared multiple times. It shows that the level of US debt, the nominal value of it is staying constant, but the percentage of the holdings of US debt by foreign entities is actually going down. And this leaves us with the most dangerous kind of debt holders out there. People like you and me, the retail investors, right? The banks. And these are the kind of institutions and investors that demand a higher yield. We know that inflation is higher than what they're telling us, right? I mean, if I'm not wrong, the US CPI is around, man, I've lost track. I think it's 3.5%, 3.6% or something. But if you just go out there to the supermarkets, look for yourself, trust your lying eyes. What do you see? I bet you, I swear to God, it's going to be more than 5, 7, or even 10%. There's a reason why Burger King, McDonald's, all these fast food joints, they're coming out with the $5 meal again, right? Because they simply know that people out there can't afford it. And because of this, the more debt America issues, it actually pushes them closer and closer towards the default. Right now, if I'm not wrong, the debt expense, the nominal interest rate on the debt is climbing up to 3 to maybe 3.5%. And the higher debt goes, it will just lead towards a bigger debt spiral where it eats up more and more of the income receipts the US government gets from taxes. And it will come to a point where countries start asking themselves, can the US get their act into order? Can they actually repay back the debt? Because it's going to lead to two disastrous consequences, right? It's either going to come to a point where the United States defaults on their debt technically, which means we are just not going to pay you. Whether you're China, whether you're India, or whether you're any of our G7 allies, right? We are just not going to pay you. That's it. What are you going to do, right? We have 10 aircraft carriers and a bunch of nukes. You're not going to do anything, right? And the other likely option is, Yellen is just going to go to Powell and ask him, you got to print up 800 billion. You got to print up, I don't know, whatever the amount is, 10 trillion, 15 trillion. Let's flood the system with liquidity. Let's shut all these bondholders up, give them back all the money that we own them, but then inflation would just skyrocket to the moon. So either way, it's not going to be a happy ending.
Seems like we're headed towards a default one way or the other. The interest payments on the national debt now exceed $1 trillion. They're larger than our defense budget and got a pretty big defense budget. Ultimately, I think we're headed towards a scenario where, as you say, either we have to simply default on the debt, although we've heard from Yellen and Powell, the political elites, how disastrous that would be. And just based on the way they've talked about it, I think what we're headed for is a default by inflation, right? Like we'll pay all of our debts, but we're just going to pay them with devalued currency. That's sort of what Alan Greenspan warned about back in, I think, 2005 in congressional testimony.
And we can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power.
How long do you think that this can go on? Now, I know this is just speculation. It's like, having a price target, timing things, but how much higher do you think the debt can get before we start to really experience the consequences in a serious way? I know we already are in terms of high inflation, but, I think compared to what's coming, today will seem relatively tame by comparison.
Well, I think it's going to go much higher. And truth be told, I believe that the world has no choice but to endure it. And let's talk about why this is the case, right? We all know that the US and China, they're going on a trade war right now. And if we look at the current trajectory of what America is doing, they're trying to reshore all the various industries, from Taiwan, places close to China, all the way back to American shores. And what are they doing? They're giving tens of billions of dollars to companies like TSMC, like Intel, for them to build and manufacture chip fabrication plants in the US, right? And we know that compared to China, South Korea, and other Asian countries like Vietnam or whatever, trying to manufacture in the US is quite expensive. And the only way for you to reshore your entire industrial base or revive it back to the point, of the 1960s, 70s, or 80s, right? The only way to do it is to incur a lot of debt. And by incurring debt, you are going to add more pressure to the US dollar as well. And you're going to have a weaker dollar over the next, 20 to 30 years' time. Everyone talks about the US dollar index going up, right? And that means that the dollar is getting stronger. But we all have to understand that the US dollar index actually trades in a range. So it might bounce from 90 to 120 and then back down to 90 and 120. It looks like everything is fine. But if you compare the dollar to gold, for example, we know that it loses 8 to 10% of its value every single year. And if we compare it to other stable currencies, like one interesting one is the Singapore dollar that I use back in Singapore, obviously. It has actually lost 20 to 30% of its value. The US dollar has lost 20 to 30% of its value versus the Singapore dollar over the last 10 to 20 years. So in absolute terms, and even in certain relative terms, the value of the dollar is actually going down. So I think everyone needs to prepare for higher structural inflation. And even the Federal Reserve, they have kind of hinted on that, right? The Fed Governor Waller, he has gone on many interviews and he talks about this thing called the R star, which basically means the neutral rate of interest rates. And he said the R star is going to be higher going forward. Now, what does that mean? The only reason why you're going to have a higher neutral interest rate in the future, the only reason you're doing that is because the neutral rate of inflation is going to be higher than 2%. I don't believe for a moment that the Fed will wait for inflation to hit 2% or even 2.5% before they do the first rate cut. I think we're going to exist in a world where the Fed will have no choice but to lift their average inflation rate, their target rate of 2% up higher. Maybe it's 2.2, maybe it's 2.5, maybe it's 3%, who knows? But I think inflation going forward is going to be really horrible and persistent.
Yeah, unfortunately, that does seem to be the case. And the Fed will do, I don't know what they'll do. One of two things, I think. One is perhaps adjust their inflation target higher, as you say, 2.5, 3%. And I think if they make that announcement, that's going to undermine confidence in the dollar significantly. We're going to see a big move in the metals and the dollar if that occurs. The other option, I think, would be that, this might be what we see also, is that they change the inflation formula, right? So they just edit the CPI formula to get to 2%, regardless of how high inflation really is, because the CPI, as you mentioned earlier, already doesn't really do a very good job of accurately representing price inflation. So maybe they'll just do that. But yeah, I don't think that there's much chance that they're going to achieve their real 2% target
Not a
anytime
chance, not a
soon.
chance.
While we're on the topic of the Fed, what do you foresee the Fed doing as we move forward? I know there's been a lot of speculation about rate cuts. Based on the latest FOMC, it sounded like maybe we'll get one, possibly two in 2024. I think that they're going to have to cut because of the structural problems that we're seeing in the regional banking system, the commercial real estate sector. There's a lot of factors that I think will ultimately force the Fed's hand in terms of rate cuts. How do you see that playing out? What's your take on that?
Well, I think the Fed is really caught in a between a rock and a hard place, right? On the first hand, we are looking at all the cracks in the banking system starting to evolve. If I'm not wrong, PIMCO, which is a kind of a hedge fund or a fund manager, they said that the banking crisis is likely going to accelerate once again. Interest rates are simply too high. Commercial real estate is on the verge of a collapse. But then at the same time, you have Biden over here constantly raising money, trying to prop up the markets. At the same time, the US is fighting two proxy wars. So a lot of money is still being pumped into the system. And you can kind of see the effects of the money starting to lose juice. There's a big problem when your deficit is around 6% of GDP and all you generate is around 1.6 or 1.7% of GDP, real GDP growth. Now, that is a very big problem. And going forward, I think the Fed has to cut at least once, maybe twice. Because if you look at the markets right now, the S&P seems to be still making all-time highs. It's defying gravity despite high interest rates and all the problems going out there. There's still money circulating in the system. And if Powell doesn't cut at least once, I think the market is going to freak out. You're going to see a big collapse. And I don't think it's going to be great for the Biden campaign as well, right? He's trying to keep everything, this house of cards still propped up all the way until the end of the elections or November, or else if there's an economic crisis, if the banks start collapsing, if the stock market crashes, I think he's going to lose to Trump, honestly. But at the same time, so it's really a catch-22. I believe the Fed is going to cut at least once, but higher interest rates, at least on the long end, when it comes to mortgages, when it comes to credit card interest rates, is going to stay higher for longer. Maybe the short end of the curve will go down. Fed funds could drop from 5.5% all the way down to 4.5, or maybe even 4% by the end of next year. But I think towards the longer end, towards the 10-year yield, I think it's going to stay elevated unless, there's a big economic crash between now and the elections.
Unless the Fed gets into the market and begins actively buying US Treasuries. I want to shift gears here a little bit and talk about something that's just been bugging me lately, and that is the reports, I believe to be false, that the petrodollar system came to an end on June 9th. And, this has received widespread coverage. I've seen headlines from Kitco, although the articles tend to just be screenshots of tweets, which are just retweeting this idea. But, you've provided some of, I think, the best coverage on your channel of the petrodollar's slow demise and how it's been getting chipped away at over the years. So if you could just give us an update on, where you think the petrodollar is heading from here. And if you want to throw in your 2 cents on these reports of an official June 9th end date recently, I would appreciate that.
Yeah, I guess the June 9 end of the petrodollar story has been circulating around, and we need to go back to how it actually started. I mean, the petrodollar system, right? It started back in the 1970s when Nixon, Kissinger went to Saudi Arabia, talked to the king, and unfortunately for all the people saying that, there isn't one single document where both of them sat down, actually put their signature on a piece of paper saying that, yes, 100% will always sell our oil for the US dollar. It was more of an understanding, a mutual understanding that at that point of time, the Saudis wanted to keep their grip on power in a very unsettled region. And the only country that was willing to do it and had the enough heft and clout was the United States. So there was an understanding that if you sell your oil for US dollars and then take the proceeds and funnel it back to US treasuries. We'll protect you, we'll give you security guarantees, we'll allow you to buy our weapons, right? And even until today, to a certain degree, it's still going on. And that's why we have to understand that de-dollarization is going to be death by 1,000 cuts. It's not going to be some miracle one-day event, a Hail Mary, Hallelujah event where suddenly the whole world decides to immediately stop trading in dollars, buying and selling oil in dollars. It's going to be incremental at the fringes before it accelerates momentum. And let's talk about one big event that it's a true sign of de-dollarization, right? And that is Yellen going and telling global banks that, hey, Russia is a full war economy. As such, you're at risk of sanctions and getting cut away from the dollar system if you conduct trade with Russia. And that obviously will translate to the oil trade, because whether you buy or sell oil, there's always a bank as intermediary in between. So what's Russia going to do? Well, obviously they can't price it in dollars, and more likely than not, they also don't want to price it in dollars. So they are going to so-called de-dollarize their own oil trade as well. And Russia accounts for around 10 or 11% of global oil production, and they sell a lot of oil. They even provide more oil to China than Saudi Arabia. So that amount of trade is going to naturally de-dollarize all the way to zero. And I think we have to appreciate that the de-dollarization story is true. It's happening, but it's going to take a lot more time than we all think that it's going to take. And there's another thing that I do have to talk about, which is the euro-dollar system, which is basically a bunch of countries, not just a bunch, I mean, the many countries out there, they all issue loans and they take loans in the US dollar out there. And the reason why they do it is because compared to currencies like the Argentine peso or maybe the Brazilian real, trying to raise money in dollars and repaying your debt in dollars is still more stable. So if the whole world at once starts dumping dollars, not transacting in dollars, this will create a very weird situation where everyone still owes each other dollars out there, but the supply of dollars goes down. And what will it mean? It will mean a global debt default. So the only way for de-dollarization to happen without us going back to dark ages is for it to be incremental and gradual. So the entire talk about a great Saudi Arabian agreement getting torn up and the Saudis 100% starting to price their oil in gold, yuan, rubles, the Saudi rial, whatever, I think that's largely false, but the dollarization is happening and we must pay attention to it.
Absolutely. And I don't mean to put you on the spot specifically about those June 9th reports. I mean, that seems to be a controversial subject at the moment. I've mentioned it a few times. I've gotten some pushback. I think one of the reasons that it's very important to understand that, the petrodollar system didn't just evaporate on June 9th is because it still persists in some form, but we are seeing it getting taken apart and dismantled over time incrementally, as you say. And I think it was around June 9th that the Saudis actually announced that they were joining the M-Bridge program, the cross-border payment system with the Bank of International Settlements and China and the UAE. And the reason that I think it's so important to note this is because if we did see overnight the end of the petrodollar system, the global economy wouldn't continue to function just like as if nothing had happened. When the petrodollar really does end, it will have repercussions for the purchasing power of the dollar, inflation, the way the global economy works. And so, that really hasn't been priced in yet. So that's the reason that it kind of bugs me when I see everybody just retweeting this, oh, petrodollar's over. It's like, it's not over. But when it does end, it will have an impact. That's sort of my take on that. Do you want to comment on the M-Bridge system and the Bank of International Settlements and the emerging CBDC program?
Right. But just to add on to the previous point, right? Let's say the Saudis really break the petrodollar system. I can almost guarantee you, within the next week or the next month, the United States will send in a flotilla and armada of ships to Saudi Arabia to get them to reinstate the entire petrodollar trade. The whole idea of this is because the US has to consistently print money or issue bonds in order to finance everything from social security to fighting the wars to maintain the entire, people call it the American empire or bases all over the world. So it is literally impossible for Saudi Arabia to immediately price everything, all their oil production, all their oil exports outside of the dollar 100% without severe geopolitical consequences, right? Not just for the world, but for themselves as well. And let's talk about the Enbridge. Now, this is a very interesting situation because it involves the blockchain. And we kind of know when you use the blockchain, and if it's not a public ledger like Bitcoin, where everyone can essentially just trace who buys what, who sells what. If it's a private ledger between, say, the owners of the system, if I'm not wrong, it's being spearheaded by China and let's say Saudi Arabia. So if a trade goes on between these two parties, let's say Saudi Arabia decides to sell 10 million barrels to Beijing, right? And they decide to settle everything in the Chinese yuan. Now, in a private ledger system, both sides know who's transacting with who. Obviously, Saudi Arabia knows they're selling to China. China knows they're buying in yuan with Saudi Arabia. But the rest of the world doesn't know. At least to people like Janet Yellen, it's going to be one big black box. And it's going to make it much harder for the US to really pinpoint and say, hey, you're transacting outside of the US dollar. And it could also apply to other cases, right? Let's say a country XYZ decides to trade with Russia using the Enbridge system, and they're doing some questionable trades. Now, if you go through the blockchain, it's also going to be quite hard, for example, the US to say that, oh, all right, China, we caught you transacting, selling XYZ dual-use goods to Russia, and we're going to sanction you for that. And because of this Enbridge, we're going to see a lot of opaqueness in the trade. Even if it doesn't concern sanctions, we are going to see a lot of masking of the trade flows. We will not really know what kind of trade goes on outside the SWIFT system. It could be that 80% of transactions in SWIFT is done using the US dollar, right? I think it's 85 or 90% even. But in the Enbridge system, it could literally be 5% or 0%. And that really obscures the fact that the demand for the dollars outside of the official, Western-controlled SWIFT system could actually be quite low. So the Enbridge system is just going to obscure a lot of information out there, and de-dollarization could actually proceed much faster than we thought because of this system going forward.
The stage is being set for that, it does appear. Well, Sean, I want to say a big thank you for joining us here and giving your insights on all of these topics. Would you like to tell everybody where they can find more of your work?
Yeah, sure. You just go to YouTube and just type in Sean Foo or Sean Foo Gold. You can get to my channel, and most of the time we cover geopolitics, economics, the market, sometimes the Federal Reserve, and occasionally we do talk about physical gold as well. So if you want to learn more about, the markets, macroeconomics in general, can just come and subscribe.
Awesome. Well, I would recommend everybody, as soon as you finish this video, go check out Sean's channel. And again, thank you so much for joining us today, Sean. We'll have to do it again sometime soon. And to all of you watching, stay safe and happy stacking. I'll catch you next time. Smart Silver Stacker out.